Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
All right, everybody, welcome back to Vantage Point with True North Wealth Partners. It is Wednesday,
Hump Day,
August 21st, 2021, and episode 13, Baker's Dozen.
Oh, yeah. Hey, Krispy Kreme, here we go.
Our producer, Nathan, brought that up, right?
Thank you, Nathan. Awesome. How you doing, man?
Good, man. Good. How are you?
Yeah, busy. We're both just chasing. We're keeping busy, that's for sure. Summer's gone fast. Kids are all in events and,
Yeah.
heard a little paintball tournament, right?
Yeah, playing paintball, sitting around waiting on my stimulus money.
Yeah, right.
We got we're in the process of adopting 8 more kids for the child credit.
Child credit, yeah.
I'm teasing.
No, but with that though, you bring up a good point. So child credit, over $100 billion started, hit the markets last week. On Thursday was the first check. So again, folks, for those that are affected by it, it's 6 months. You may have to pay it back. So just spend wisely and be careful of all that.
Sure.
So instead of waiting for the year and take normal tax credit adjustments, they're just trying to get everybody hooked on the monthly paycheck.
Yeah.
Deposit, direct deposit.
Front end, yeah. And then going forward, then it'd just be a credit on your taxes.
Correct.
On that. So, yeah.
Of which they're trying to make permanent.
Oh, yeah.
So hopefully it's not permanent, but we'll see. Yeah, well, good, man. Let's get into COVID. That's been interesting. It was going down. You can see on the chart, you can see the United States tumble there and the other countries as well. And of recent, the past few weeks, a little variant spike. So
sure, yeah.
What do we have on that? Would you add any more color to that? Sort of spooked the markets, I guess. Friday, Monday, among other things.
Yeah, Friday and Monday. Yeah, so definitely some concerns of the rebound with the variant. I think most analysts, at least our research partners, aren't. I mean, it's something to obviously keep an eye on, right. But I don't think they're overly concerned per se about that happening. But but of course, something that they're watching, that I think everybody's watching, and just trying to be a little extra cautious. But further lockdowns in over in Europe, or actually I take that, but Great Britain's, I think they were supposed to come out of their
lockdown, right?
And then California, of course, kind of locking things down again for
masking up,
even vaccinated people, I guess. But so yeah, crazy times for sure. Still with COVID, so it's just something to, I guess we're not out of the woods yet, with COVID, but hopefully I think it seems like in Ohio, just different states, it seems like they're not. If something if there was a resurgence, there would kind of be a different approach as far as regarding how they handled it. So
yep, I agree. I'm with you.
So we'll see. Yeah,
there's a lot that's occurred in the news. So we'll sort of recap a few things, what we're doing to the models, et cetera, and repositioning things as we go into the Q2. Yep. Great earnings. So
second half,
here we go. Q2 earnings started out last week. So that's what the idea was, to sell in, rebalance in. We've been doing that, and we will complete the rebalance here by the end of the month. So will have seen some trade action over the past last week, this week, and into the month end.
It always goes a little slower than you anticipate, right? Sometimes,
but which is sometimes good though. Yeah, you do see dribble take time, because of certain sectors. It's rebalance. I got out of some other thematic sectors as well. But earnings. Earnings are still killing it. Earnings per share and the sales growth are. This will be the best order, Q2 earnings and growth estimates. So that's great. I'm glad to have that. Comps, Q2 over Q2 last year to this year, piece of cake. Q3, Q4 will be a little more challenging. So again, we think more headwinds going in the back half of the year for sure. Market volatility should pick up. Mm-hmm. So, what we saw Friday, Monday, expect more of those days is what we're trying to say.
Yeah. Boy, I remember when the Dow, if it was a bad day, the Dow was down 100.
Yeah.
I mean, it's just like.
No, I'm with you. So with that, we had the S&P retrace 3% or so from the highs. Okay, and that's already come off the 3%. So that was actually 6 times the S&P year to date has been down 3%-ish. Sure. So again, the most was about 4.9% in February, there. So we technically still haven't hit the 5% pullback by definition of 5%, and the S&P pulling down by at least 5%. So we haven't hit that officially yet. Remember, folks, it's 4.5 times per year has been the average time, amount of times that the S&P does pull back 5% or more, and we haven't officially hit it yet. But we're going to definitely have at least 3, 5, could be even seeing 8%er between now and heading into fall. So that's why we're getting ahead of it, reeling in the risk models, some bringing down risk overall tolerance, the variance both up and down. We're just bringing all that in. Earnings, we talked about selling into it. So great earnings, Coca-Cola, Johnson & Johnson, Verizon killed it, crushed it among all the banks. Netflix didn't. So the forward guidance is really what's setting these markets off is with the forward guidance. So not a lot. Some of the companies, not a lot, but some of the companies are not as optimistic as others. So forward guidance has been tempered.
Is that because of the stimulus money? So that all of a sudden it's gone and people aren't spending.
But also there's the opposite. I mean, just influx of money too.
Too much money.
Too much money. Them too. Money supply. So they're still printing money left and right. Will they start tapering the bond buying of 120 billion a month? So hopefully they'll start to bring that down. So it's just that's why we have inflation, which we'll get into inflation here.
Yep.
Just one final thing on the Dow on Monday. So on Monday, when the Dow dropped, over 700 points, it was down 725. It was minus 2.09%. That was the biggest drop in the Dow year to date. So minus 2.09 on Monday for the Dow was the biggest year to date. So just expect more of those between now and the end of the year. Again, no recession. This is all part of the chop.
No panic. No need to
What
panic.
we're heading into now is it was really called the chop or quad 3. And as you'll see, this is Andy and I. We're Fred and Barney from the Flintstones. So we're just driving along there. So, what is indicators? What's a flash of bulbs? So me being a car guy, oh, no, it's fun. No, so as you can see on this, it's just to add a little levity to the transition. So there's a shift in the overall economy from quad 2 into quad 3. That is the call that's happened. We got the signal last week on that. So from one of our research partners, Hedgeye. So again, just to recap, quads 1, 2, 3, 4. 1 is great. Obviously 2 is where we came out of for the past 3 quarters. We're shifting down. So if you're going 75 miles per hour, we're just going to go now 50 miles per hour. Still growth. You're still going to get there, but it's much slower. So overall growth is slowing down. So that's the quad that we're heading into. That just basically means slowing growth. Still you have inflation. You could hear the term stagflation be thrown around. So you may hear that pick up a little bit later. So that's quad 3. And then obviously quad 4 is what we came out of. That was, not good. That was during the COVID era. So we're just utilizing different asset classes and sectors that should do well entering into transitioning phase into a quad 3. So that's why you've been seeing all that.
Yep.
So into inflation. So inflation, some CPI numbers that were reported, Consumer Price Index. With that, it was a hot number of 5.9%, okay, year over year. Okay, now that is just your normal CPI inflation. But when you exclude, which is core, that's a 4.5%. Okay, so core excludes food and energy, which I wish they wouldn't do that, but they just, for whatever reason, they calculate it 2 different ways. Because, what has been going up? Food and energy.
Yeah, really.
So anyway, so it's 4.5. So as a recap reminder, again, roughly 1.75% has been inflation average for the past 10 years in that range. So more than double.
Yeah,
so
it's big.
It's parts of the inflation, like lumber. We've talked about that in the past. Spike up, spike down.
That's more transitionary or, temporary.
Temporary, right. So, okay, that's the temporary phase for that aspect. But the true inflation is sticky. It will be here with us for at least the next 3 quarters. So as an example, Hedgeye and even Argus, our research partners, I mean, they're mentioning, over 3.5% print on CPI inflation for the next 3 quarters. And Hedgeye even mentions 4% print we'll see in the third quarter. So, it's not, it's more than double. That's what we're trying to say. So it's here for at least 3 more quarters.
Yeah, and as a result of that too, then you have an adjustment to the Social Security benefit.
Yes.
The cost of living adjustment that Sometimes you get, sometimes you don't. But in October, they'll announce that they're anticipating about 4.5% increase starting in 2022.
All right.
So to keep up, and they do that as inflation bumps up, right? Then that means if you're receiving a certain benefit amount, then your dollars have less purchasing power.
Right.
So they want to try to keep that benefit up to about what inflation bumps up to. So anticipate that.
Yeah, which we're all going to need it. Those folks who are on it, they're going to need it to try to keep up, because
absolutely
the dollar's losing ground right now.
That's right.
So we talked about many things on what's going on. One little indicator, a flash bulb that came out. I thought this was an interesting stat coming from one of our research partners too. So just the smart money, dumb money confidence survey. So on Monday, when we had to pull back on the Dow there, that was enough to push the dumb money confidence below the smart money. So smart money is more institutional, CEO confidence, things of that nature. Dumb money, they call it retail investors.
So we're dumb money.
Yeah,
is that right?
No.
I'm dumb money.
No, but that's the Robin Hoodies. I'll leave it at that. So with that said, basically, this was the longest stretch ever that they had. So it was 289 trading days that dumb money was above or greater than, more confident than the smart money. Well, all of a sudden, now it has ended on Monday, and so it resets again. And so now, again, it's 260 days in a trading year. And again, we just ended 289 as far as the longest streak ever. So again, a lot of cross currents, just things that are going on. A lot of M&As are occurring, mergers and acquisitions here locally. A couple, Safe Light, Safe Auto, things of that nature. Safe Auto is being bought by Liberty Mutual. So a lot of the
good time to do that.
Yeah, a lot of the
a lot of cash.
Cash, that's exactly right. So while the money to supply is being printed, these companies are sitting on tons of cash, and L Brands here again locally spinning out Victoria's Secrets, et cetera. So going on their own, renaming. Some just finer facts or things of that nature. So, earnings growth, we talked about great. Inflation, yes, high. Full year GDP, for the full year is at least 5.7%. That's coming from August as well. In regards to just changing to China briefly, we talked briefly on that, but they have a one-child policy was the rule. They dropped it. They changed it a couple years back to a two-child policy. Then they changed it to a three-child policy recently, and now they're talking about dropping all child policies, so you can have as many kids as you want by 2025. So they have to, because they have way too many. The influx, the bell curve is just ridiculous for the older generation, and not enough younger kids to support and pay into their regime and their ways of life.
Too many boys. If everybody wanted a boy, right? So it was like they knew they were having a girl, they would have an abortion.
Right? Yeah.
Or put up for adoption.
Yeah, that's true. So they're paying for their ill ways.
Yeah, and China still is the largest peacetime buildup of their military in peacetime history.
Don't forget that, folks.
Right now, so
it's happening. Taiwan, we're praying for you. Yeah,
doesn't look good.
Doesn't look good, especially under this regime's watch. So watch out. Another tip of the month. Maybe let's get into this. So with the tips of the month, how long was the recession?
3 months.
Close. Bing. 2 months.
Oh, that meant 2.
Yeah, that's 2. All right. So tips of the month. So there is an entity. It's called the National Bureau of Economic Research, the NBER. Just officially announced yesterday. Came out on Tuesday. That the bottom occurred in April. So February and March. So it lasted 2 months. It's the shortest recession ever in the history of the stock market. So it was a 2-month recession. It only lasted 2 months. COVID was a unique bird altogether, but that's official. So
that's just crazy.
Yeah, no, we hear you on that. No recession like we talked about. It declines, 5% easily could happen in the blink of an eye. Markets move fast. Anything else, Sandy, that we may need to hit on here?
I don't think so. I think, the rebalance, still diversified. Nothing to worry about. Nothing like, major changes. Just, we're making
tweaks.
It's a little bit bigger of a rebalance, but just anticipating the second half of the year, some funds we want to switch out of. It's just kind of ride the market cycle, and
we'll keep adapting, stay ahead as much as we can with all the information that we're on, calls and webinars multiple times a day. So we're staying plenty busy, and I appreciate you all. So,
One other thing would be if I'm an investor, I have an account, how do I, what's a good index to compare it to, right? Because you always hear the Dow Jones, the S&P 500. Those are the two big ones. Of course, there's hundreds of indexes.
Right.
And so, we use, of course, behind the scenes.
GPI.
Yeah.
Dow Jones.
So we use so the Dow Jones has the conservative, moderate conservatives, moderate aggressive indexes.
Lines up to our 5 models or models in general.
So those represent more of what our clients have, a diversified portfolio, right? Because the S&P and the Dow, those are all 100% stocks.
Correct. And you're not 100% exposed to that. So
so those, even though it gives you some indication, though, the S&P is up, the Dow, my account should be up.
Should be up, right.
But it's not apples to apples.
Nope. No, I hear you. We're doing our best to keep it real, relevant, and timely as best we can with the information that we have. So
that's right.
Again, stay well, enjoy summertime, and next month we're actually going to have a special guest. So we'll have Cindy. So she'll be helping with.
Nice.
So she bring a lot of information in regards to nursing homes, assisted living, different strategies one can use. That's her field and topic. She's helped my folks, my siblings, my aunt personally as well in the past. So they bring a lot of resources and credit and a lot of information. So we'll have her on, and look forward to that.
Yeah, it'd be great.
Enjoy.
All right, guys. See everybody. Thanks.
Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.